Do you want to know the biggest mistake that investors make? That's what I'll be sharing with you in this video and how you can avoid it. I'm going to tell you why it happens, been there, done that, trust me, and how you can avoid it. Hi, I'm Camille Gaines. I'm a financial author. I write about investing, about money at my blog, retirecertain.com. I don't manage wealth for others. I just have a strong interest in investing and in money. I've always enjoyed it, and I write about it at my blog. And in this video, I want to share with you the most common mistake that investors make with the stock market based on multiple studies. So what it is, and it's so easy to do this, is investing with emotions instead of investing with facts and data. There is so much information that you can use to make investing decisions. But what happens is investors start feeling a little intimidated by all the information. They're not sure what information to use. They may get distorted information, and even bigger, emotions get a hold of us when it comes to our investing. And that's because we've got to have food and shelter. It goes back to our survival. You know, we have this part of our brain that keeps us safe and that triggers fear and emotions when we worry about things that will provide food and shelter for us, and of course that's money. Then there's all kinds of other, related issues. There's lack of confidence and fear, and all sorts of other emotions that can be triggered around money. So in this video, I want to share with you what happens related to the stock market and other investments as well, really. But because most people equate investing to the stock market, I'll share it in the stock market. Now, I did another video that shows you, all about this and the cycles and how this happens. So be sure to take a look at that. But what happens is from the other video you'll see, or you're probably familiar with, in the 1990s, we had a huge bull market. Everybody loved stocks. That's my little heart right there. And everybody was planning on similar returns in the next decade. Well, that didn't happen. What happened in the next decade is the stock market, and this is the S&P 500, dropped about 3%. And that excludes dividends, but about 3% over that next decade. And ouch, right? That's, if you had been headed into retirement right here at 2000, that would have been really painful. And even though you can wait out those downturns, when the market, we enter these nasty bear markets, which happened twice in that first decade of the 2000s, even though you can write it out, you won't have an actual loss unless you sell your investments at a loss. You can write it out, which is what a lot of investors do, but that drop in your net worth is so incredibly painful, right? Because you've still got to say, where am I? And when you have a drop in your net worth of 50%, or say if you're invested in, multiple assets, including maybe a home, maybe the drop in your net worth is only 25%, but it's still pretty painful, right? And so what happens is everybody loves investing here, and we start thinking with our emotions. We start hearing our friends are in the market, our, whoever, relatives that have been in the market, made all this money, and we've just got to get in. And that comes from greed. That comes from that feeling that we have just absolutely got to get in. And then often that happens at the very top of markets, when the valuations are very high, just before the price of those assets or those investments is about to drop. And so then everybody hates the investment after it does drop. But those exact same assets, and this is for quality assets, when we go through these bad times, these recessions that are related to these bear markets, I've got another video on that. Stocks and other investments that aren't quality get fleshed out. They can be, dangerous. Going into recessions, we want higher quality, safer investments. There's no doubt. They get fleshed out. So what happens is those same quality assets that we're selling up here become much cheaper down here. But everybody hates stocks, and they don't want to buy stocks then because, well, they've already been burned. The market may have dropped 50% here. That's the NASDAQ went down about 70% here. Yikes, right? And it took over a decade to recover. So over here, we saw about over 50% drop in stocks. These are quality stocks. And so those same stocks, though, are cheap here, those stocks that are the same here are much more expensive, and then they're cheap down here, but nobody wants to buy them. That's the biggest mistake that investors make. And really, the mistake is more about holding on and then selling down here and then buying up here out of that feeling, that greed, that feeling I've got to get in on it, and then selling down here because you just can't take the pain anymore. So I've been there and done that. I started investing when I was in my early 20s. So I get all this. It's hard to not follow the herd. It's hard to not buy into what everybody else is doing. But when you can have an awareness around this and stop and go, well, wait a minute, that same quality stock, it looks, it hasn't had any major changes in its operations. It's able to get through a recession. Its earnings are, still reasonable, if not increasing. It's, when you can buy it down here cheaper, then it makes so much sense than loading up here. And so that's the mistake that investors make, is investing with emotions instead of the facts and data. Because the facts and data will show you what's going on here. And while we don't know exactly when things will change with the market, we can use those facts and historical data as a guide to help us invest with less risk and avoid investing with our emotions, which is the mistake that investors make. If you like this video, let me know by clicking the thumbs up or the like down at the bottom somewhere here. Subscribe to my channel if you want to see more videos on this, and I appreciate your watching.